Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel. Thank you for all the subscribers and the comments. I greatly appreciate it. Here at this channel, we are dedicated to the rational investor, the investor that's looking for cash flow and buys stocks to buy that cash flow. We're not interested in charts, colored lines, or fancy squares. What we're here to do is to value each investment on its underlying cash flow, come up with what we think the value of the stock is, and then compare that value to what's traded in the public market to come up with what our economic return would be if we held the stock over a period of time. Our period of time is 10 years. Now, at this channel, we look for 5 key attributes for all of our investments, and that is top-line revenue growth, earnings growth. We define earnings at the enterprise level, so it's Ebitda earnings. Strong free cash flow, debt needs to be less than 3 times EBITDA, and a well-priced stock. Well-priced for us means it's a market multiple, enterprise value divided by EBITDA. We need those 5 key attributes to line up for us to consider the investment. And this week's investment that we will look at is Costco. Behind me is their 10K. Now their 10K ends fiscal year as of August 2020. It's a big report by the time they get it out. It is now November, and we are going to go through it because it's just been released. Now, they had a very, very good year in 2020 with COVID. A lot of people are shopping at grocery stores, Costco among them, to cook at home. And it's reflected in their very robust earnings. But what we're going to do is we're going to go through, we're going to figure out what the historical cash flows have been, what we think the company's worth, then we're going to compare it to the market and see what we think we can earn by holding the investment. Now, I normally go through the 10K in more detail, but this time I want to skip to one particular page that I thought was very interesting, and I applaud Costco for putting it out there. And that page is number 19. This chart in their 10K summarizes every year the number of stores that they've opened up and the average revenue of each store generated both the year it opened and the subsequent years over time. And we'll put this chart up for you so you can see it a little closer. It's an amazing chart that stacks revenue over time and gives you a very scalable model to use to forecast the business. And I applaud Costco for putting it out there and keeping it up to date year in year. Let's take a look at the numbers and see what we think Costco is worth. So behind me are 9 years of revenue and earnings for Costco. The last, in 2012, remember this is as of August ending, so it's August 2012 and prior, the 12 months, they generated $99 billion of revenue. And that has grown over that time from 2012 to 2020 to $166 billion of revenue. That's for an annual growth rate of 7%. And that certainly checks our box for top line revenue. And it's a nice number, not double digits, but for a grocery store chain or wholesaler like Costco, it's a pretty robust number. Ebitda has done the same. So Ebitda has followed suit. 1, it's positive every single year, which is fantastic. 2, it continues to grow. It grew like revenue. So it started at $3.7 billion in 2012. It has grown to a peak now, given COVID response, to $7.7 billion of EBITDA. That is a 9.7, call it 10% annualized growth rate over that period of time, which is very strong for a grocery store chain. So fantastic news there. Let's go look at enterprise value and figure out what the enterprise value of Costco is. So beside here, we've got their debt. The first piece of looking at the enterprise value is how much debt or leverage is on the balance sheet. And here you can see in our chart it starts with 1.3, call it $1.4 billion of debt, and it grows to a peak of $11 billion here in the last fiscal year. They do have lots of cash on hand, which is nice to see. So cash on hand is basically the investable security line on the balance sheet. They actually have more cash than this, but I've only pulled this particular line as to be conservative, but this would be the cash that we can use to buy down debt or distribute to shareholders because it's really not germane to the business operations. Market cap. Market cap is shares outstanding times price. And you can see the market cap for Costco was $42 billion and has grown to $150 billion over this time frame. That's roughly threefold in market cap growth. Debt, as a comparison, has gone from 1 to 11. Cash is relatively flat. So when we add the debt, add the market cap, less the cash, you get enterprise value. And enterprise value is what we look at with the value of the businesses is at the enterprise level. And that has gone at $44 billion up to $160 billion over this time frame, and that is roughly 4 times growth over that period of time. Now that's strong growth on the enterprise level, and it's much stronger than the Ebitda growth that we've seen. If you recall, if I go back and show you Ebitda, right? Ebitda has doubled over this time period, but market cap is enterprise value is almost 4 times. So what's going on? And you can see it right here in our value measure, enterprise divided by Ebitda. That is basically the number of years Costco will take to generate the cash flow to buy itself, which is a great measure. What's the payback period? In other words, that's another way to look at it. It's payback period. So the payback period, or the enterprise value to Ebitda multiple, has gone from 11 times all the way to 21 times in the last fiscal year. So this market multiple expansion means that investors are paying more for the same level of cash flow than they did previously. And that has contributed to the growth in the market cap that you're seeing. The Ebitda doubled, enterprise value went up 400%. That extra, 300% would be the market multiple expanding from 11 to 20. So that means in 2012, for every dollar of Ebitda that Costco earned, an investor was paying $11 in enterprise value or for the company. Now, every dollar earned, they're paying 21 times. So it's definitely a premium. Current market price puts it in the 23 multiple range on last fiscal year's Ebitda. Last thing is debt. Good thing here, debt definitely checks the box. It is less than, it's 1.3 times last fiscal year. I'm netting outstanding debt with cash to come up with the low debt. So it definitely has low debt. Let's take a look at cash flow, and we'll see where that stacks up. Cash flow from operations, that's where we pick up from us. It's the first third of the cash flow statement. $3 billion in 2012 to $8.8 billion or almost $8.9 billion in 2020. That's a 14% growth rate, which is actually slightly stronger than the Ebitda growth rate that we saw. So that's very good. And the growth rate of Ebitda and the growth rate of cash flow from operations are in line with one another, which is a good accounting check that the guys and girls over in the accounting department are expensing costs properly. Capex seems to be pretty steady, growing as they build and expand stores. Let's take a look at the delta between the cash flow from operations and Capex. This is pretty strong, right? You've got $8.8 billion of cash that comes in the door. You put $2.8 billion back into buying new businesses and left over, and you're still left with $6 billion lying on the cash table that you're like, well, what do I do with it? They don't have too much debt, so you'll notice that the debt on this chart kind of goes positive, negative as they borrow or spend and repay debt. Recently, it has been positive. That probably reflects the slight increase in debt that we've seen over the last 8 years. I add all these up and I get the free cash flow to equity holders. This is what you are buying when you buy a company, and this is what the company should be based on in its value. If we keep going through this chart, you'll see shares outstanding really haven't moved. They're not either issuing shares and they're not buying back shares. Shares are fairly flat year to year. If I take free cash flow to equity divided by shares, I get free cash flow to equity per share. Last fiscal year, $15.79, a monster number, all-time high number. And you can see, again, that number is the result of very strong cash flow from operations, $8.8 billion, minimal capex, $2.8 billion. That leaves $6 billion. They borrowed a little bit of money to produce almost $7 billion of free cash flow that is available to the equity holders. Divide by the shares and you get a very, very robust number. All right, let's finish out the cash flow statement. So then I've got the yield here, which is basically the free cash flow per share divided by share price. And you can see it's hovered in that 4.3 range over the last, 9 years. and it's 4.6 recently. Also, based on a comment that I got on one of the channels, to add the return on invested capital, the ROIC. So I'm adding a new column to this chart where you can see what the return on invested capital is for the company. This is basically what are they generating off their assets, what kind of income are they generating off the assets. That's a 17% return. When they put their cash out, their CapEx going out, that's how the average return they're getting on their investment based on some balance sheet numbers that we use. It's a healthy double digit, not something I've seen that's stellar, but it's definitely above their cost of capital, which means it's accretive. That's a good thing. Now what? Let's forecast. In order to forecast, I want to do one thing, and I want to go back to the retail location chart that we saw previously in the 10K. I have replicated here for you in Excel, and we're going to do some interesting numbers and forecast forward to see what we think EBITDA could be if they maintained this. Now, we need to figure out what is this chart, how do we read the chart? And that's very important. Off to the left, and I'll make this chart bigger so you can see it in full screen, but off the left-hand side, you've got years. Years going up is actually increasing in years. And then going off to the right is increasing years as well. This column here is the number of wholesale locations that they open every single year. And you can see in 2012, they opened 15, then they opened 26, then 30, and so on and so forth. This year, in 2020, they opened 13 locations, slightly less than average, probably because COVID. Now, going to the right on this chart, what does that mean? If I take the 2013 year as an example, I come over to the chart where it says 99 right here. And what that is that is $99 million of average location revenue for the 26 locations they opened that year. So each of the 26 generated $99 million for that year of revenue. And then you go to the next year over, 2014, same line, you'll see the numbers now $109 million. So those same 26 locations got established, more people started going, and their average revenue per store of that year grew to 109 million, then it grew to 113, then 116, 124, so on and so forth. What you'll notice is that that cohort of restaurants that they opened in 2013, every year the revenue continues to grow of those stores. And the same is true of 2014 and 2015 and 2016. It's really remarkable, and I kudos to Costco for putting this chart out. I really would like to see every retailer that is public put a chart out like this, because it gives you the scalability of their operations. It shows you how, as they build a location and that location begins to generate cash flow, it's accretive to the overall organization. And then way down here at the bottom, this line here, it says 2011 and before. So this is basically every store they've ever opened that's still in existence, and its average revenue per store. Now, here's where we get the fun part. If I expand this down, and this is me pushing into what they gave us, but basically building out for a revenue model so we can estimate what their EBITDA is and get a feel for their numbers, I can take average revenue up above times the number of stores that they have on hand and get an estimate for total annual retail revenue. I then add the membership revenue, which is what you can pull from the 10K. I add a little bit of an other to give me the number they reported in the 10K. In this instance, 2015 annual revenue reported was $116 billion. I also have their EBITDA, which we calculated and you've already seen, and their EBITDA margin is a low 4%. Now we have revenue, we have a way to stack it, we have an EBITDA margin. Let's go forecast. So what we're gonna do now is this is a forecast. All I've done is I've taken the same pattern that they were following before, where they had stores out into the future. I've now assumed 20 stores opening every year. And I'm blocking the 20, it's tough to see, but you can see it if I move it to the center. You can see the 20, I'm using 20 stores every year. I'm pulling average revenue that they've generated historically for the first year, and then I'm saying that's going to grow 10 or 11% for the first 2 years, following some historical patterns, and then it'll tail off and grow at 6% from then on after year 3. And I stack. And I say, give me 20 stores every year for the next decade, build it up, and what does it mean? So I'll follow this over, building average revenue up, and then I sum the whole thing, what they've already built, plus my additions in 2030, and I get a revenue of $310 billion. Membership revenue, it's my total guess, but I'm using existing membership revenue growth growing over time, and I get $6 billion. Then I get a little bit of other. There seemed to be an other there to help me bridge to the final number, which is revenue target of $328 billion. I can then put the same 4% Ebitda margin on it, and I get $13.36 billion of long-term Ebitda in a forecast. And what I'm going to do is I'm going to take that and I'm going to plug that into the model. It adds to roughly a 6% growth rate over time. For simplicity, I used to do 6%, and it gives me $13.7 billion. I also looked at the street, some long-term forecasts that I was able to find. It seems like the analysts that are out there in the street agree that this kind of $13 to $14 billion long-term EBITDA target range is appropriate. And then what I've done is I've assigned a 15 market multiple to it. And you might wonder why. It is definitely lower than where it's currently trading. Like we said before, it's currently trading at 22 times earnings, which is a premium. If you look at it, it's the highest it's ever traded in almost a decade. I definitely feel that this market is at a premium. Given the uncertainty with the economy, it seems a little much to be paying such a huge premium. So I'm saying that a fair value for this business is back at its average, more of the 15 range. You can see it here, averaging. So if I take just 13 to 20, average 15, I get a 15 times, which puts the enterprise value at $200 billion. Less debt, add shares, gives me a market cap of just shy of $200 billion. Divide by the shares outstanding of 442 million, gives me a price target of $438 a share. Now this is the EBITDA market multiple approach. If I take that same 6% growth rate and I apply it to a free cash flow number of $13.69, basically what I'm doing is I'm taking this number here, the cash flow from operations and the capex, that sum. I'm not adding this debt. I don't want them to grow their debt balance. I want to be conservative. This is borrowed money. It's not true free operating cash. So I'm going to take the net of these two, divide by my shares 442, and I get 13.69. I grow that at 6% for a long-term forecast of $23 per share of cash flow. At a 4x yield, I get $578 of a long-term price target. Now let's put these two price targets together, right? So you've got one price target, which is a market multiple approach, which is here the EBITDA market multiple. This is kind of the investment banker's model, if you will, the market multiple. And then free cash flow, which is what we buy as cash flow. I got two different two different valuations. I'm going to average the two. I get $508 as a long-term price target. I'll put that into an economic return model that says the business is going to generate this stream of cash flow behind me. I'm going to buy this stream of cash flow for $378 now. I'll sell the future stream at that point for $500 in the future, and I get a series of cash flows that I can then IRR. And when I IRR it, that's the annualized internal rate of return. It's time weighted. It's not just a simple average. The further out in time the large cash flows are, the more it weighs on the return, the less the return is. So it's a conservative way to look at it. It's where the professional look at it. IRR 8%, which is wildly mediocre at this point. And I think what you're seeing here is a very strong and robust company that is participating in the general boom that is the S&P 500 and the overall market, and it's being traded at a premium that I'm not sure it's worth right now. I love the company. The growth model feels really real to me. I can string out the wholesale locations, and it seems extremely plausible that in 10 years they could have $13 to $14 billion of earnings. The problem is I'm not sure they can sustain a 22, 23 times market multiple for over a decade. I'm willing to bet that that number comes down, especially if their growth comes down. So I've given it a 15 handle, and what you're seeing is that 15 handle way on the economic return here at 8%. But let's recap for a second all of the attributes for Costco. Top line revenue growth, absolutely. Strong revenue growth. Ebitda growth, yes, it was 10% annually, is fantastic. Strong free cash flow, absolutely. We saw that $6 billion they had left over. A good balance sheet, yes. 1 times debt is conservative, good. Well priced, I got to pass on it. I think no. So I think it hits 4 out of 5. The big one being price. You don't want to pay too much for a good company. You want to pay a fair price. I think 15 is a fair price. I think you hold off, you wait for it to come down, and then you step in. But it's definitely a position you should hold, or you should consider holding at the appropriate price. But I do like the company. Let's give you a little bit of an IRR distribution curve. So here, $347 is the current price target. As that price increases, the economic return goes down, assuming the same long-term EBITDA. But if it falls, if the price should fall someplace back down to the 270 mark, then it's a very attractive return at 13% annualized return at that point. So for us in this channel, it's going to be a pass for the moment. I'd give it a meh, but I think you continue to watch this. If you get a pullback, it's definitely a good, well-run company, and would be a good investment for someone to hold long-term who wants a conservative portfolio. All right, this is Costco. I hope you've enjoyed the analysis. My name is Cameron Stewart, CFA. Thank you very much for watching the channel. Please comment below. Tell me what stocks you want to see, and I will try to continue to crank through them. Hit that subscribe button, and I'll see you next time. Thank you very much. Bye-bye.